Hello, and welcome to Emerging Viewpoints. I'm Nick Stadtmiller. Today we're joined by Selva Demiralp to discuss Turkey's inflation problem, central bank policy, and exchange rate management. Professor Demiralp is on the faculty of the Economics Department at Koç University in Istanbul and is director of the Koç University TÜSİAD Economic Research Forum. Previously, she was an economist with the Federal Reserve Board from 2000 to 2005 and has worked as a consultant for the European Central Bank. Hocam hoş geldiniz. Professor, welcome.
Hoş bulduk.
Consumer prices in Turkey have grown by about 74% from a year ago, based on the official measure, and the lira has lost about half its value in the past year and is down by about 2/3 since the beginning of 2020. Meanwhile, the central bank actually cut its policy rate last year, and the main policy rate now stands at 14%. To what extent is loose monetary policy responsible for current conditions? And what can be done to right the ship to bring down inflation and stabilize the lira?
So inflation is primarily the central bank's problem and it's central bank's job to achieve price stability. So in any country, when you have prices getting off the track and a central bank that fails to achieve its inflation target, then the first entity that you blame is going to be the central bank. And the same is true for the United States, same is true for Turkey. Just like when you ask Jerome Powell who we should blame for inflation in the US, and he says this is our responsibility and we are the ones who are going to bring inflation down. Turkish central bank has the similar job, and if we have 74% in official inflation, where the rest of the world is also suffering from some global factors, but the inflation rate elsewhere is about 10%, then the difference is due to policy mistakes implemented by the central bank. And what are those policy mistakes? Nick, as you mentioned, central bank, despite increasing inflationary pressures in the last quarter of last year, where Turkish inflation rate was 20%. Normally, when you have an inflation rate of 20% and your target is 5%, then you implement policies to bring inflation down, which is tight monetary policy. But Turkish central bank started an easing cycle, and with forward guidance, they said in the foreseeable future, you should not expect any rate hikes from the central bank. So what happened in a couple of consecutive meetings? They cut interest rates by 5 percentage points, and inflation rate increased from 20% to 74%. So clearly one can see the connection. If the rest of the world implements tight monetary policy to fight inflation, there is a reason for that. Economic theory tells you that in order to fight inflation, you have to implement tight policy to control demand. And in emerging markets like Turkey, it's not just the demand inflation, but also the cost inflation coming from the imported goods, which are indexed to exchange rate. So if you cut local interest rate and local currency depreciates, then prices of imported inputs are going to become more expensive, and you're going to experience a supply side shock along with a demand side shock, which is triggered by low interest rate policies. Now, it's true that there is a global inflation coming essentially from supply side, coming from the supply chain disruptions during the pandemic, coming from Russia's invasion of Ukraine and the increase in food and energy prices. But if you are importing those goods from the rest of the world, like Turkey is a major oil importer, and we also import wheat from Russia and Ukraine, what happens is that internal prices of those items are going up and imported prices are increasing even more because of the weak Turkish lira. So whichever way you look at it, either from demand inflation, because in Turkey right now, inflation rate is 74%, but the loan rates, let's say, are about 25 to 30%. So clearly you can borrow at a negative real interest rate. So it's very easy. I mean, from a rational economic agent's perspective, it wouldn't make sense not to borrow. And the more you borrow, the higher will be demand. So low interest rates are feeding demand inflation. And because interest rates on Turkish denominated assets are low, Turkish lira is going to weaken against major currencies. And that's going to bring the supply side inflation. So yes, low interest rate policies, I think, is the root cause of the Turkish inflation we are experiencing. And who is in charge of the low interest rate policies? It's the central bank. So it's a long answer, but I could have said it in one sentence. It's the central bank that is in charge, and low interest rate policies are, I think, to blame for the inflation that we are experiencing right now. What should we do? We should do whatever the rest of the world is doing, which is tight monetary policy, and that should be supported by the government as well. Monetary and fiscal policy should work in coordination. There is a reason that Biden met with Yellen and Powell at a meeting because they want to signal that they are working in harmony, that fiscal policy and the president is supporting the Federal Reserve. And that type of a message is going to calm down the markets and give the signal that the government will fully support the Federal Reserve, and the two policymakers, the authorities, the fiscal authority and the monetary authority, are not going to pull the economy in opposite directions. In other words, when the Fed tightens, the government is not going to implement accommodative policies, and the decline in demand that will be due to Fed's policies won't be offset by the increase in demand due to, let's say, tax cuts or increase in government spending. Turkey has to give the same message in order to convince the markets that government and the central bank will work in harmony, and lowering the inflation rate is going to be the priority, just like they say it in the United States. And even in the United States, once the Fed started slipping with respect to its inflation target, we have seen a decline in Fed's credibility. It's still much stronger than the Turkish central bank, but we know that once you lose credibility in the eyes of market players, then you have to tighten even more in order to illustrate that you are determined to do whatever it takes to get inflation under control. So Turkey has to show the same determination and signal that they are going to do whatever it takes, just like what Powell says, to lower inflation rate. It's hard for Powell to convince the markets, even harder for Turkey, because our central bank, with a 74% inflation rate, clearly has a very weak credibility, and there are already question marks about the independence of the central bank.
So, in your mind, if the central bank of Turkey were to implement an orthodox monetary policy, how high would the policy rate have to go and for how long? And what would that do to the real economy?
That's the $1 million question. It's not an easy question to answer because it's not just about interest rates anymore. I mean, right now, if Turkish central bank increases interest rates, let's say by 10 percentage points, 15 percentage points, or even 20 percentage points, it's still going to be less than the inflation rate. But that doesn't mean they should not increase interest rates altogether, because it's a signal in the right direction, and it will tell the markets that, okay, we understand that there was a mistake with our policy stance before. Now we are moving to the orthodox view, and now we are going to implement tight monetary policy to take inflation expectations under control. It depends on how convincing the central bank's arguments will be. With the current staff, I am not sure if the markets are going to be entirely convinced. So a regime changes perhaps would be easier. By regime change, I mean a new central bank governor and a new assignment of credibility, like just like in 2001 when the law changed and central bank was granted independence. We have to do something similar to that. We have to open a new page and note that just like Turkey did in 2001, where in a couple of years, inflation rate declined from 70% to 8 or 9%, we are going to show the same determination. We are going to let the central bank implement its optimal policy. So giving this signal and making it convincing is the challenge in the case of Turkey. But it's never too late. It's never too late to correct your past mistakes. And you have to start from somewhere. I am not saying that overnight Turkey can increase interest rates by 15, 20 percentage points, but even signaling that we are going to start, let's say, by 10 percentage points rate hike, and we are not going to cut interest rates anytime soon, and fiscal policy is going to help out the central bank. If you can give these messages in a credible way, yes, it's not going to be an immediate cure to the inflation problem, but at least gradually it would take inflation expectations under control.
So, the government's new economic model is to keep low interest rates in an effort to boost production, exports, and employment. And officials say that given time, that eventually capacity will increase and the current account will come into balance because of higher exports. And ultimately, this will stabilize the lira and bring inflation down. Do you think this model is feasible?
The signals coming from the government is actually confusing because, yes, for a while, at least let's talk about the last 6-month period. First, we were told that with the new economic model, low interest rate policies and competitive exports will be the way to go. But then we have also seen Turkish central bank selling its foreign currency reserves in order to keep the exchange rate at a certain level. Why? Because Turkey's external debt, both private sectors and public sectors altogether, is about 60% of the GDP. That's a lot of foreign debt. And depreciation in the Turkish lira increases the debt burden of both the private sector and the public sector. So, because of this detrimental impact, they were not able to continue with the competitive exchange rate policies and try to keep lira from depreciating even further. And as a result, what happened is that due to low interest rate policies, inflation rate in Turkey increased. But normally you expect the exchange rate to move hand in hand with the inflation rate. But because they have been selling foreign currency reserves, exchange rate did not depreciate as fast as the inflation rate. So in real exchange rate terms, Turkish lira actually started to appreciate because the nominal exchange rate didn't depreciate as fast as the inflation rate. So in terms of the value of Turkey's exports, we did not really, we were not able to maintain that competitive edge, and the prices of our imports started to remain just as expensive. So, in addition to this, so yes, they said weak lira and exchange export oriented policy is our goal. But then we were not able to keep the lira low because of our external debt problems. And as you know, while those policies were implemented, we have seen Turkish central bank governors saying that these policies are actually going to lower Turkish inflation rates. So by keeping interest rates low and increasing Turkey's exports this way, we are going to generate capital inflows. That's going to prevent the supply side inflation because prices of our imported goods are going to remain low. But this didn't happen. And even though central bank lowered interest rates, we have seen inflation rate not coming down, but going up. And very recently, when our Treasury Minister, Finance and Minister of Treasury and Finance had a speech sometime last week, and he said we could have hiked interest rates in order to offset inflationary pressures, but we chose to grow with inflation. Now, that's a U-turn in my view because it means they are not arguing that low interest rates are going to lower inflation anymore. Because 6 months ago, the argument was that low interest rates are going to lower inflation. But now we are told that we chose not to hike interest rates because we wanted to grow together with inflation. So it's not the neo-Fisherian argument that is put on the table anymore, but we are moving to a more orthodox view where the government acknowledges that in order to fight inflation, we had to hike interest rates, but we chose not to. So as you can see, it's hard to see where all these pieces fit with this new economic model because the new economic model was telling us that low interest rate policies would lower inflation, but now they are saying that we chose to grow with low interest rate policies. So, I mean, as an academic, I've been trained to see how the orthodox view works, and this new policy stance that is expressed by the Minister of Finance and Treasury is something I can understand and relate to. And I can see that typically governments do have this urge to push growth as much as they can because they have a more narrow time span. Election cycles are shorter than the inflation cycles. I mean, we have seen similar pressures in the United States, for example, with Donald Trump asking the Fed to cut interest rates. In a similar way, Turkish government also asks Turkish central bank to cut interest rates. The difference, though, is our central bank does not have independence. Our institutions are weaker, so Turkish central bank is more likely to give in to these pressures. And the second layer is that this trade-off between growth and inflation may work in the short run, but if it becomes a systematic policy, it's not going to work anymore, just like we see in Turkey right now. Why? Because if you keep lowering interest rates in order to stimulate demand, yes, on the one hand, you are increasing that aggregate demand is increasing, but at the same time, inflation is decreasing demand because it increases poverty. So you cut interest rates, stimulate demand, but as you keep cutting interest rates below the inflation rate and accumulated inflationary pressures are going to lead to a decline in purchasing power, and that's going to decrease demand. In Turkey right now, the inflationary effect of accommodative policy is actually speeding up, and long run is becoming short run. Normally, governments prefer to lower interest rates and increase demand. And by the time they have new elections, the high demand already gains the votes for the government. But what we are experiencing right now is that on the one hand, demand is increasing due to these accommodative policies. But on the other hand, because almost at a weekly basis, we see prices going up when we go to the market. The negative impact of inflation on demand is also gaining momentum. So on net, I would say the negative impact of inflation on demand starts to outweigh the positive impact of low interest rate policies. And this is something that I try to relay. This is the message I want to relay whenever I comment on the Turkish economy, because this is what I call a contractionary expansion. Yes, on paper you implement expansionary policy, but on net it will have a contractionary effect. Like since central bank cut interest rates by 5 percentage points, market interest rates actually went up. They didn't go down. Why? Because inflationary pressures are going up and risk premium is going up, and market interest rates, which incorporates those two factors in its prices, is increasing as a result.
So you talked about the trade-off between higher interest rates and lower growth and lower inflation to a more stimulatory environment where you have low interest rates with higher growth and higher inflation. But my question to you is there a way that the government could implement the key pillars of the new economic policy of boosting production, growth, exports, and employment whilst implementing orthodox monetary policy? In other words, what policies could they implement to boost productive capacity and employment in the Turkish economy?
I don't think we need to reinvent the wheel, and I don't think we need to look at the very distant past. We don't even look at the other countries. We can just look at our own history. In 2001, we had a major crisis. And after the crisis, as I mentioned, Turkish central bank was granted independence, and inflation targeting started a couple of years later. And during that time, we have seen tight monetary policy, but because there was credibility, because there was belief that central bank was sincere, and it was complemented with a fiscal discipline, we have seen high growth rates. There was, yes, tight monetary policy, which on paper is going to slow down the growth rate, but the opposite happened because the confidence in Turkish economy led to capital inflows, and we were able to achieve a disinflationary period together with high growth, and there were major structural reforms implemented during the same time period. In fact, the infrastructure that was set up during that period was the primary reason for the success of the first AK Party period, let's say from 2004 to 2010. So we can do something similar so long as we prioritize price stability and financial stability first. And once we convince the markets that we are not going to deviate from the basic fundamentals of orthodox policy, then the rest is going to be easier, just like we did in 2001. So to me, the recipe is very clear. And yes, it is what we call a bitter medicine. But once we show the patients, we may not need to wait that long to uh, reap the benefits of these policies. And we have done this in the past, and there's no reason why we cannot do it again.
So you mentioned earlier the Central Bank of Turkey's intervention in the foreign exchange market to prop up the value of the lira. Now, in 2019 and 2020, the central bank spent an estimated $120 billion to prop up the lira, only for the central bank to abandon this effort as the intervention proved too expensive. And then more recently, in December, I estimate that the central bank spent about $16.5 billion in 1 month alone. And then in the first 5 months of this year, about another $37 billion in intervening in the foreign exchange markets. Now, I'm not even going to ask you how successful this was, because we can all look at a chart of the lira's value over the last several years. But my question is, after all this intervention, we see what the weaker balance sheet of the central bank is. After you exclude foreign currency borrowed from foreign exchange swaps, true net foreign exchange reserves at the central bank are at about minus $50 billion. So what can be done to replenish those foreign exchange reserves and shore up the central bank's balance sheet?
I feel like in the end, the point that I come to is always going to be the same. Going back to orthodox policies and prioritizing price stability as the only goal of the central bank, actually. In Turkish law, it says Central Bank of Turkey is in charge of inflation targeting and price stability. We don't even have a dual mandate. So if central bank goes back to achieve its goal, I think most of our problems are going to be solved because yes, we want to keep the value of Turkish lira a bit stronger in order to reduce the burden of our private sector and the public sector, the external debt burden. But to do this, to strengthen Turkish lira, what we need to do is to increase the interest rate that we offer on Turkish denominated assets. Selling central bank reserves, foreign exchange reserves, is a very risky policy. And those reserves are there for extraordinary circumstances, like for a very short time period, if you realize that there's an external shock and you want to sterilize the effect of the temporary shock on the economy, then using central banks' foreign exchange reserves is the right time to do that. But if we are talking about using central banks' foreign exchange reserves as a substitute for orthodox monetary policy, then that's very risky. And clearly, we are not the Federal Reserve. We don't print dollars, we print Turkish liras. And the dollar reserves that Turkish central bank has is rather limited. Clearly, we quickly ran out of our foreign exchange reserves. And as you mentioned, right now it's at a negative level. It only becomes positive after we incorporate the borrowed reserves through swap agreements. That's a very risky and unsustainable policy. It's increasing Turkey's risk premium. And if Turkey wants to build up its foreign exchange reserves again, first you need to reestablish confidence in Turkey's policies. With the right policies and the right signals, again, I'm going to give the example from after 2001. During that time, we have seen major capital inflows, and at that time, central bank actually accumulated a lot of foreign currency reserves because this time, when capital there is confidence in Turkish economy and capital starts flowing into Turkey, Turkish lira starts appreciating. So you don't want Turkish lira to weaken too much, and you don't want Turkish lira to appreciate too much. So that would be the perfect time for you to start buying foreign exchange from the markets and accumulate your foreign exchange reserves. But to do this, first you need to establish confidence. Right now, I mean, since the beginning of the pandemic, there has been major capital outflows from Turkey, and there's hardly any foreign direct investment or hot currency in Turkey right now. But if we compare this to the period after 2001, around 2006, Turkish FDI, foreign direct investment, reached record levels, like $20 billion. And like I said, following the same type of policies, a confidence in an independent central bank, a determined central bank, and a government that supports the central bank with fiscal discipline is going to achieve the capital accumulation that we very much need in terms of central bank reserves.
One thing you mentioned earlier was that even though the Turkish lira has depreciated, it hasn't kept pace with the inflation gap between Turkey and its major trading partners. And I'm curious, let's say for the sake of argument that the government's current intervention program, or the central bank's intervention program, that is actually successful and they're able to stem the lira's declines to say 40 to 50% this year, but inflation is likely to run north of 70%, which is going to create a significant real appreciation for the lira. What are the effects of a real exchange rate appreciation for Turkey on the real economy and competitiveness?
Yes, so that's a very good point because that actually goes against the idea of the new economic program. If Turkish inflation outpaces the depreciation in Turkish lira, then Turkish exports are going to be more expensive and our imports are going to be relatively cheaper. And that's going to lead to a widening of Turkey's current account deficit, if anything. And coupled with the high energy prices, it's just going to be a further negative impact on the Turkish current account. I think that's one of the reasons why major institutions like the IMF or the World Bank or the OECD keep revising down Turkey's growth forecasts for 2022, coming both from the negative impact of inflation on local demand, but also coming from Turkey losing its competitive edge on our exports because of the reasons that you have mentioned, because in real terms, Turkish exchange rate is actually appreciating.
We'll have to leave it there for now. Hocam katıldığınız için çok teşekkür ederim Professor. Thank you very much for
Ben
a
teşekkür ederim.
fascinating discussion.
Ben teşekkür ederim. It's my pleasure. Thanks for having me.